Hello guys, welcome back to Financial Academy. If you are seeing me for the first time, my name is the Financial Academy. On this channel, I am teaching everything concerning the forex market, the stock market, the crypto market, and also the real estate investment market. So if you like what I'm doing, please make sure to like this video, make sure to subscribe to my YouTube channel, and also comment down below if you have any single question concerning this video. Understand? So in today's video episode, I'm going to be teaching you everything you need to know for what is forex to the end of forex. I'm going to be teaching you the forex basics tutorial from the beginning to the end. So this video is going to be divided into 12 episodes. So I'm going to be teaching you episode by episode from episode 1 to episode 12. So but in today's video, I'm going to be focusing on episode 1, which is the forex introduction. So make sure to stick with me, and also make sure to watch this video from the beginning to the end, because you're gonna be learn and understand the introduction of forex, the history of forex, the basis of forex, everything concerning the forex market. In this my first episode, you'll be able to learn, understand, and grasp everything you need to know and understand in the first introduction of the forex trading business, so that you won't be left out, and so that you won't be confused when learning and understanding the business basis. So make sure to stick with me, and also make sure to like this video, subscribe to my YouTube channel, and also comment down below, ask me any question concerning this video. I'll be glad to answer all your questions. Please stay with me, and let's go down to my screen right now, because when we go to my screen, I will be able to break down everything for you. So let's go to my screen. Let's go.
Hello guys, welcome back to my screen. So let's continue from where we stopped in my introduction, which I told you that I will be guiding you on this our first episode of this forex trading journey, because I will break everything down for you from the beginning to the end. So let's continue right now. Introduction to the forex trading, the ultimate guide for beginners. So if you are a beginner, this course is for you. It's designed in 12 segments. So this is the first segment. So after this first segment of this course, I will dive into the second segment, which will be on my next video. So let's continue. Forex, known as foreign exchange or FX, is the largest financial market in the world, where currencies are bought and sold. Every day, over $7 trillion is traded in the forex market, far more than the stock market and the cryptocurrency market combined. So, but what exactly is forex trading, and why has it become one of the most popular ways to make money online? You understand? Let's break it down in this complete beginner introduction. So, in this thing, you'll be asking yourself, why is it that the forex trading has the biggest and largest liquidity? Not just like that. Why is it that the forex market is the largest financial market in the world? For those of you who doesn't know, the forex market is the biggest and the largest financial market in the world. It is bigger than the stock market. It is bigger than the cryptocurrency market. It is even bigger than the New York Exchange stock market combined together. Understand? So over $7 trillion is being transacted in the forex market every single day. Over $7 trillion. So that shows how big, how profitable, how liquid the market is. Understand? So that makes it the biggest and the largest financial market in the world. So no other financial market is bigger than the foreign exchange market. So in this case, you'll be asking yourself, what is forex trading? Forex trading is the exchange of one currency from another. You understand? Forex trading simply means the exchange of one currency for another. Let me give you for example. If you travel from Nigeria to United States, you will need to exchange your naira to US dollar. The rate at which you exchange them is determined by the foreign exchange market. Understand? So for you to travel from Nigeria to United States, you need to exchange your naira to dollar. So any price at which the exchanger gives you, that is what we call the forex trading. You have already traded the forex trading, but you doesn't know that you have already traded the foreign exchange market. So however, In forex trading, you will not exchange your physical money. Instead, you are speculating on whether one currency will rise or fall against another. So now, in this situation of forex trading, you are not traveling. What you are doing is that you are speculating with your mobile phone, with your mobile smartphone or your laptop. You are speculating whether this currency will go up or whether this currency will go down. So this is basically what you will be doing in the forex market. Understand? You are not changing with the physical dollar. No. What you are doing is that you are trading with your smartphone. Understand? So let's continue. For instance, if you believe that the euro, which is being given the sign by EUR, will rise against the US dollar, which is USD, you buy the euro USD pair. If you think the euro will fall, you sell the euro USD pair. So this is the simple concept of buying low and selling high, or vice versa, and it's the foundation of forex trading. Understand? So this, for me, this is the simplest explanation that I can give you, that I can give to anybody who is watching this video, who is a beginner and want to start out in forex trading. Understand? This is the simplest definition that I can give you. So if you believe that the price of the euro will go up, you simply buy. And if you believe that the price of the euro will go down, you simply sell. Understand? So let's continue from where we stop. How the forex market works. So in every business have procedures, so as forex market. So forex market have its works. Understand? It has how it operates, so as other businesses. So let's continue. This forex market is a decentralized global market, meaning that there is no central exchange or physical location. Trade happens electronically through banks, brokers, and financial institutions around the world. Are you getting my point now? So the forex market is a decentralized global network. Understand? So it doesn't have any central location where it is being done. So it is a decentralized global network whereby there is no central exchange or physical location, and it is being traded and it is being traded electronically, by meaning online, through the banks, through the brokers, and through the financial institutions around the world. So every countries in the world have banks, have their own financial institution. So foreign exchange is being traded around the world by different banks, different brokers, and different financial institutions anywhere in the world. You understand? So, and superior to this, it now lead us to the four major forex trading session, because in trading you have trading session, so which I will be explaining to you. You have the seeding session, which starts as 10 o'clock p.m. to 7 o'clock a.m. GMT. So if you are in Nigeria, understand, watching this video, or if you are in any part of the world watching this video, what you need to do is to shake your time. You can change this GMT time to your own time. For example, if you're in New York, you can change it to Eastern Standard Time and know the time is 4, but this time is now time for. If you're in Nigeria, then you can know if this time suits you if you're in Nigeria. Let me begin. Sydney session start from 10 p.m. in Nigeria in the night and stop at 7 a.m. in the morning. If you're in Tokyo, which is Japan, it starts from 12 a.m. in the midnight and stops at 9 a.m. in the morning if you're in Nigeria. Then if you're in London, it starts at 8 a.m. in the morning in Nigeria and stops at 5 p.m. in the evening in Nigeria. Then if you're in New York, it starts at 1 p.m. Nigerian time and ends at 10 p.m. Nigerian time, or West African time. You understand? So this session is what you call the trading session. There are 4. We have the Sydney, we have the Tokyo, we have the London, and we have the New York. And in this session, overlap is also very important. For those who doesn't know what is overlap. Overlap simply means creating period of high trading activity and opportunity for trading. For example, the London and New York overlap. Understand? So we have overlap whereby the London session and the New York session are meshed together. During this time period, there is a higher, bigger movement of currency and asset in the market. Understand? And it starts at 5 and it starts at 1 p.m. in the afternoon of Nigerian time to 5 p.m. in the evening of Nigerian time, and it is the most volatile and most often the profitable time to trade in the forex market. You understand? So this period is the most volatile and the most active period in the forex market, and also this period is most profitable time for you to trade in the forex market. You understand? So let's continue. The key concept every beginner must know. So every beginner who is starting this forex trading business, you must know this key concept. Understand? So as businesses grows, so there are many concepts to different businesses. So there's no difference in forex trading. Understand? So you need to understand the concept of the business that you are involved in, so that you won't be left out. Understand? Before trading forex, it is essential to understand the basic blocks of the forex market. Understand? So it is very important for you to understand the basic things you need to know about the forex market before jumping into the forex business. Understand? So that you won't make any mistake in the long run. Number one, currency pairs. Currencies are traded in pairs. Understand? For those of you who are watching this video for as a beginner, currencies are traded in pairs. For example, Euro USD, GBP USD, or USD Nigerian Naira. I'm just giving you an example. The first currency, Euro, is called the base currency. So anytime you are in your chart and you see the first currency pair, it is called the base currency. And the second, which is the USD, is called the close currency. That means two currencies are paired together for them to be traded. So once you see the first currency, it is called the base currency or the main currency. Then if you see the second currency, it is called the base currency. For example, if Euro USD equals 1.100, it means that 1 euro equals $1.10. You understand? So it means 1 euro equals $1.10. That's what it means. You understand? So let's continue. Second one, pips. For those of you who don't know what is pips, a pip means percentage in point. It is the smallest price movement in a currency pair. For most pairs, 1 pips equals 0.0001. Understand? So pips is what will determine your profit and your loss, in the sense that when you are buying the market, it depends on how many pips that you want to risk in the market and how many pips you are targeting. So, and each pip movement depends on the lot size that you are using, will determine how much you will make and how much you will lose in the market. You understand? So let's continue, but we will get there very soon. If Euro USD moves from 1.100 to 1.010, it means that the market have moved by 10 pips increase. Understand? So if the Euro USD move from 1.000 to 1.0 to 1.101 to 1.1010, that means it have moved by 10 pips. Understand? So let's continue. What is leverage? Which is number 3. Leverage allows traders to control a large position with a small amount of capital. You understand? Yes. Leverage is more like a money loaned to you by your broker for you to trade a larger position of trade with a small amount of money. For example, with 1:100 leverage, you can control $10,000 with just $100. But remember, leverage magnifies both profits and losses, so it should be used carefully. Are you getting my point now? That your broker is loaning you money doesn't mean that you will trade it without managing your position. No. So your leverage will magnify your profit, and at the same time your leverage will magnify your loss. The only advantage in leverage is that it will help you, you have the potential to buy a bigger position in the market with little amount of money. For example, with the leverage of 1:100, you can control $10,000 with just $100 in your trading account. Understand? Let's continue. But you need to be very careful when using leverage. because it will magnify your losses, and at the same time it will magnify your profit. Understand? Let's continue. Number 4, lots. Lot means is the standard of trading size in the forex. Lot size is the standard of trading size in the forex. So in forex we have what we call lot size, which is the standard of trading any size in the market. Understand? So in trading we have standard lot, we have mini lot, and we have micro lot. By this, standard lot is equals to 100,000 units of the base currency. Understand? While mini lot is the 10,000 units of the base currency, and then micro lot is the 1,000 units of the base currency. Meaning that if you are going with one lot, it means, which is the standard lot, it means that for every pip movement, which I have explained before, you'll be making $10 for every pip movement that goes in your favor. So if the market goes against you, you'll be losing $10 for every pip movement. Understand? If you're making use of mini lots, it means that for every pip movement you are making $1, and for every pip movement, if it goes against you, you are losing $1. Then if you're making use of micro lots, it means that for every pip for every pip movement you are making 10 cents, and for every pip movement that goes against you, you are losing 10 cents. You understand? So it is the lot size that will determine your profit margin, your profit and your loss. Because the higher your loss size, the higher your profit, and the higher your loss. But the lower the loss size, the lower the profit, and the lower your loss. So the ball is now up to you for you to choose. But all of these things you need to be wisely. Understand? So new traders often start with micro lot size to reduce risk while learning. Yes, of course, it is advisable that as a beginner who is starting forex trading newly, you need to start with a micro lot size which is 0.01 for you to start, which is 10 cents per pip movement, so that you will reduce your risk. And when you are still learning the forex market, are you getting my point right now? So let's continue. For what is bid and ask price? The bid price is the price at which you can sell a currency pair, while the ask price is the price at which you can buy a currency pair. Understand? So the bid price is the price at which you can sell any currency asset. That is the bid price. Then the ask price is the price at which you can buy a currency pair. So the bid price and the ask price are the prices that the brokers will give you for you to know, okay, this currency pair I'm selling it at this price, and okay, this currency pair I'm buying it at that price. Then the difference is between the bid and ask is the spread, because the difference between the two of them is called spread. And this is how the brokers make money, because the brokers we need to make money from trading. So the difference between the bid and ask is the spread. So that spread in your bid and ask are what brokers makes from trading, for facilitating your trading for you. So it is more like, just call it the broker's commission. So this is the commission that the brokerage firm is taking from you for them to liquidate your trade and put it your order in the market. Understand? So let's go down to the next topic. Why trade forex? Understand? For every businesses, you need to understand, why am I entering the businesses? Understand? You don't just wake up one morning and start venturing into business without knowing your reason or your why you want to trade forex. So now in this very video, I want to tell you why trade forex, why forex is very, very good, and why you need to trade forex, and why you need to venture into the business and skill of forex trading. Let me explain. There are several reasons why forex attracts millions of traders worldwide. Understand? So different type of business attract different type of people. So and there are several reasons why forex attracts millions of traders worldwide. Let me give you the reason. Number 1, high liquidity. Of course, high liquidity. With $7 trillion traded daily, you can enter and exit position easily. So with $7 trillion that is being traded every day, in the forex market. You can enter the market and you can step out of the market easily. Understand? Because it is very, very volatile, it is very, very liquid. By liquidity, it means there is a high amount of money flowing in the business. Understand? That's what it means by liquidity. Number 2, 24 hours market. You can trade anytime from Monday to Friday. Yes, of course. You can trade the market anytime from Monday to Friday. 245. Understand? From Monday, Tuesday, Wednesday, Thursday, Friday, you can be trading the market, and it is very active. 245. Understand? Number 3, low entry barrier. When I mean by low entry barrier, I mean you can start trading as little as $10 in some cases. Yes, of course. You can start trading as little as $10 depending on the kind of broker that you are using. You can start trading as little as $10. You understand? Number 4, potential for profit in any market condition. Yes, you can make money whether the market is going upward or whether the market is going downward. Understand? Yes, of course. You can make money from every market condition. Whether the market is going upward, you buy. Whether the market is then going downward, you sell. So you can make money in the both side of the market, and which is not so in other businesses. Understand? Number 5, leverage. Leverage, small capital can control larger position, increasing profit potential. That's of course. With your small capital, you can increase your profit potential with leverage. Once you understand the business and understand the skill of forex trading, understand. So with your small capital, you can grow it to big capital. Understand? But you need to be skilled enough for you to know how to flip an account. But I will teach you that in my subsequent videos. Understand? But let's continue. The risk of forex trading. So once there are advantages of something, that also is disadvantage. There's also the other side, the bad side of business. Understand? Every business has good side, and every business have its own risk. So now I'm gonna be telling you the risk of forex trading, because every business, there are risks in every business. So you need to know the risk appetite or the risk exposure of any business. So as to forex trading, while forex can be profitable, it is also risky. For those of you who doesn't know for the first time, forex is risky. Many beginners lose money because they underestimate the market or fail to manage risk. Understand? Reason why many beginners fail in the business is that they fail to manage their risk, because forex is risky. You can lose your money. Understand? That is why you need to manage your risk very, very well as a beginner. And here are some common risks in the forex market. Understand? Leverage risk. Using too much leverage can wipe out your account. For those of you who doesn't know, using too many leverage, high leverage will blow your account. Number 2, volatility risk. Sudden market move can cause losses. When the market moves with speed, sometimes it can cause losses if you're not very careful. Number 3, emotional trading. Fear and greed often lead to bad decisions. Yes, of course. Some traders are fearful, and some traders are greedy, and sometimes it can lead to bad decisions in the market. Number 4, lack of knowledge. Understand? Trading without understanding the basics can lead to failure. That is why I'm taking my time to explain everything in details for you. Understand? Trading without understanding the basics of this business can lead to failure. So you need to acquire knowledge. You need to acquire knowledge. It is very, very important. I know why I'm standing it like this. You need to acquire the basic knowledge and understand this market very well before you can start to risk your hard-earned money in the forex market. Let me give you tips. Always practice on a demo account before risking real money. Yes, of course. You need to practice on a demo account in your MT4 or MT5 before risking your hard-earned money. Let's continue. Types of forex traders. So as other business, there are types of people who are doing the business. So as forex trading, depending on your style and time availability, you can choose one of these trading types. Understand? Because you have different types of traders. We have the scalpers, which make many small trade per day to profit from tiny price movement. Understand? So what scalpers normally do is that they make many small trades per day to profit from small tiny price movement. Understand? These are what the scalpers do on their trade. Number two, day traders. Day traders, they open and close trade within the same day. Understand? Day traders, what they do is that they open and close trade within the same day. Number three, swing traders, what they do is that they hold trades for several days or even weeks. So swing traders, what they do is that when they enter their trade, they can hold their trade for several days or even weeks. Then position traders, what position traders do is that they hold trades for months, focusing on long-term trend. Understand? So what they normally do is that they hold trades for months, focusing on long-term. But mainly position traders are more of investors who are investing on the long term in a particular currency asset. But you as a beginner, you'll be focusing either on scalping, day trading, or swing trading. Are you getting my point right now? So let's continue. Tools you need for you to start trading. It is very important. You need tools for you to start trading, because every business have things that you are required of for you to start the business. So it is not different in trading. Before you begin, you need a few essential tools. Understand? Number one, reliable forex broker. Understand? Reliable forex broker is very important, because these people are people that will be facilitating your trade. Understand? It is very important. Example, you have XNES, you have IC Market, you have XM, and you have Deriv. These are some of the brokerage firms that are available and that are reliable, and also that are regulated, because you need to use a brokerage firm that is highly regulated so that your money and funds will be very safe. That is why I'm listing this for you, that are highly regulated and it is licensed: XNES, IC Market, XM, and Deriv. Number two, trading platform. Most brokers uses MetaTrader 4, which is MT4, or MetaTrader 5, which is MT5. So most trading platform make use of MT4 or MT5. That is why if you can go to your Google Play Store or your Apple Store and download it on them, search for MetaTrader 4 and MetaTrader 5, or MT4 or MT5. You will see it there in a blue icon, and download it. Number three, stable internet connection. Yes, of course. For the fact that you will be using your smartphone, you need to have and be in a position where there are stable internet connection, because you'll be trading with your smartphone, so that you need to be connected with the internet so that you can know the price movement at any instant point in time. Understand? Number four, risk management plan. You need to have a risk management plan in hand whenever that you want to begin your trading career or your trading journey. Number five, trading journal. You need to track your progress and performance whenever you execute your trade, whether it is a winning trade or a losing trade. The most important thing is that you need to know and learn from them. If it is a winning trade, learn from the winning trade. If it's a losing trade, learn from them and keep building your journey. Understand? Because I always say this: Forex is not a sprint, but Forex is a marathon. Understand? It is a marathon. It's not a sprint. So you need to take your time, step by step, to build your journey in this business. Understand? Then I'm gonna be giving you a pro tips for beginner traders. So I'm gonna be giving you a pro tips for beginner traders. Number one, learn before you earn. Yes, of course. Learn before you earn. Understand how Forex works before investing real money. It is very important. Learn before you earn. Acquire knowledge first. Understand how Forex works. It is very important before you invest in your real money, so that you don't lose up your hard-earned money because of lack of knowledge. Be very careful and be very cautious about that. This is number one. Number two, use a demo account. Make sure to practice risk-free until you are confident enough to enter in your real account. Make sure to practice risk-free until you are confident enough to start trading on your real money. Number 3, risk only what you can afford to lose. Yes, of course. Risk only what you can afford to lose. When you cannot afford to lose $100, please don't risk $100. If you can afford to lose $20, then risk $20. It is very, very, very important. Also, number 4, always use stop loss orders. It is very, very important. Make sure to always make use of your stop loss whenever you are in trading. It is very, very important. Number 5, focus on one strategy at a time. Don't have so many strategies as a trader. No, focus on one strategy at a time so that you don't get confused. Are you getting my point? Number 6, avoid trading based on emotion. It is very, very important. Don't trade out of sentiment. Don't trade out of your emotion. No, trade what you are seeing in the market. Trade what the market is giving you. If the market is showing you buy the market. If the market is showing you sell the market. But if the market is not giving you a clear signal, my brother, please step out of the market. Wait for the market to give you a clear signal, then before you enter. Understand? Number 7, keep learning. Keep learning. The market is constantly changing, and successful traders keep adapting. Understand? The market dynamics constantly change, and successful traders keep adapting. So that is why you keep on learning. So trading is a long life journey. So you keep on learning. But as a beginner, you need to learn the basic, what we gotta do for you to start the business properly. But when you are in the business, you keep learning. You keep learning. You keep learning, because learning never ends. Understand? Then in conclusion of this segment, forex trading can be a powerful way to build wealth. I agree with that 100%. But it is not a get-rich scheme. It requires education, discipline, and patience. Understand? It is very, very important for you to learn this. Forex trading can be a powerful way to build wealth, but it is not a get-rich scheme. It requires education, discipline, and patience. Understand? By learning the fundamentals, currency pairs, leverage, risk management, and trading psychology, you will set a strong foundation for you. Remember, every professional trader was once a beginner. Start small, stay consistent, and keep learning. The world of forex can be open door to financial freedom if approached wisely. Understand? So it is very, very important for you to stay smart, for you to start small, and for you to keep on learning, and for you to be consistent in this journey. At the very long run, you'll be very happy, and it will give you financial freedom. Let's continue. What is forex trading? Understand? Then this forex trading this one is for complete beginner guide. Understand? Which is the second segment of the first episode. Understand? Have you ever wondered how to make money by buying and selling currencies online? Or why the US dollar and euro seems to rise and fall in value every day? Welcome to the world of forex trading, the largest and the most liquid market in the world. You understand? In this content, you will learn everything you need to know about what is forex trading, how it works, why people trade forex, and how you can understand how you can start safely as a beginner. Understanding forex trading. Forex stands for foreign exchange, the process of exchanging one currency for another. In simple terms, forex trading is the art of buying one currency while simultaneously selling another. The goal is to profit from the changes in the value of these currencies over time. Are you getting my point? For example, if you believe the euro will strengthen against the US dollar, you buy the euro currency pair, and if the euro rises in value, you can sell it for a profit. It's that simple. But the key is understanding when to buy and when to sell. Understand? the size of the market, the size of the forex market, so as other business, so many businesses have different sizes. But the forex market is the largest and most liquid market in the world, with a daily trading volume exceeding $7 trillion as of 2024. To put this into perspective, the New York Stock Exchange (NYSE) trade about $200 billion daily. The forex market trades 35 times more than that every single day. Understand? So this massive liquidity means that traders can enter or exit position instantly without worrying about delay or price manipulation. Are you getting my point now? Then when does forex trading open? Unlike the stock market, which has fixed hour, the forex market is open 24 hours a day, 5 days a week, because it operates across different time zones. And there are 4 major trading sessions around the world, which is the Sydney session, Tokyo session, London session, and New York session. Are you getting my point now? When sessions overlap, particularly which is London and New York, trading activity and volatility are at their peak, creating more opportunities for traders. What is a currency pair? Currency pair in the forex market are always traded in pairs because you are buying one currency and selling another at the same time. Each pair is written in base or quotes. For example, Euro USD is equals to 1.1000, meaning that 1 euro equals to $1.10. If the price rises from 1.1200, the euro has gained value. If the price drops to 1.0800, the euro have lost value. Some common forex pairs include Euro USD, GBP USD, USD JPY, and USD NGN, which is USD Nigerian Naira. Euro versus the US dollar means Euro USD. GBP British Pounds versus US dollar means GBP USD. US dollar versus Japanese yen means USD JPY. And US dollar versus Nigerian Naira means USD NGN. You understand? Let's continue. How forex trading works. When you trade forex, you risk speculating on the direction of currency pairs. There are 2 main types of trades: buy or long, sell or short. When you buy or long, you profit when the price goes up, and when you sell or short, then you profit when the market goes down. For example, if you buy Euro USD at 1.100 and sell it at 1.100, you make a profit of 100 pips. Because a pips means percentage in points. It is the smallest unit of price change in the forex, usually 0.001 for most currency pairs. Important forex trading terms you should know. As a beginner, you need to know and understand these important trading terms. Bid and ask. Bid meaning the price at which you can sell the currency, and ask the price you can buy the currency pair. And the difference between the spread and the difference between the bid and ask is the spread, which is how your broker earn their own commission. Leverage is how traders control larger position with small amount of money. For example, 1:100 leverage, you can trade 10,000 US dollars using just $100 in your trading account. However, leverage is a double-edged sword. It amplifies both profits and losses, so you should be very, very careful. Lot size. A lot represents the amount of currency you are trading. We have one standard lot size which is equal to 100,000 units, one mini lot which is equal to 10,000 units, and one micro lot which is equal to 1,000 units. Beginners often start with micro lot to manage their risk. As a beginner, make use of micro lot to manage your risk. Number 4, margin. Margin is the amount of money required to open a trade. Understand? Margin is the amount of money required to open a trade. It acts as a deposit to cover your potential losses. For instance, if your broker requires 1% margin, you only need $100 to open a $10,000 position. Stop loss and take profit. Stop loss means automatically closes a trade when it hits a certain loss level to protect your capital, while take profit closes a trade when it reaches a specific profit target. Understand? Tools are vitals. These tools are vital for risk management in forex trading. It is very, very important. Why people trade forex? Why millions of people around the world are attracted to forex trading? Number one is because of accessibility. You can start it with small. You can start with a small account and an internet connection. Number two, liquidity, easy to buy and sell due to high trading volume. Number three, flexibility. You can trade anytime from anywhere in the world. Number four, leverage. You can control larger positions with limited capital. Number five, profit in any direction. You can either earn in both sides of the market, whether the market is rising or whether the market is falling. Then the risk of forex trading. While forex offers great opportunity, it is not without risk. Here are some of the main challenges. Number one, high volatility. Price can change rapidly and unpredictably. Number two, leverage risk. Too much leverage can wipe out your account quickly. Number three, emotional decision. Fear and greed often lead to poor trades. Number four, scam and fake brokers. Always trade with a regulated broker that I have said before. Always trade with a regulated broker. That is why I gave you XNES, Deriv, XM, and other brokerage firm that are regulated. But this one that I give you is the one that I'm sure that are very, very regulated, and the one that I'm using. Understand? Let's continue. Let me give you this tip. Never invest money you can't afford to lose. Please, as a trader, never invest money that you can't afford to lose. It is very, very important for you to learn this. How to start forex trading step by step. If you are ready to get started, here are some simple roadmap. Number one, learn the basics. Understand forex term, trend, and trading strategy. Number two, choose a reliable broker. Go for regulated broker like XNES, Deriv, XM, or IC Market. Number three, open a demo account. Practice trading with visual money to gain experience. Number four, develop a strategy. Plan your entry, exits, and risk management. Number five, start small. Begin with a small account once you are confident. Number six, track your progress. Keep a trading journal to learn from your mistakes. Number seven, keep learning. Follow forex news and continuously improve your skill as a forex trader. Number one, the next step, example of a forex trade. Let's say that you buy GBP USD at 1.25, believing that the British pounds will rise against the US dollar. A few hours later, the market moves to 1.2550. That is a gain of 50 pips. If you are trading one standard lot size, you have made $500, which is $10 per pip movement. This is the basic idea behind profit and loss are made in the forex market. Then in conclusion, forex trading is the art of predicting currency movement and profiting from them. It is a 24 hours global opportunity that anyone can join, but it requires knowledge, discipline, and practice to succeed. Are you getting my point right now? So if you take your time to understand how forex works, manage your risk, and trade wisely, you can turn it into a long-term path to financial independence. But the key takeaway is this: forex trading isn't about luck; it is about knowledge, patience, and strategy. Understand? Let's continue with the next journey, which is the history and evolution of forex from ancient trade to digital market. Understand? Because every business have history, so I need to tell you the history of forex trading, so that you need to know the history of the business that you want to venture into. Understand? That is why I want to tell you the history of forex trading. Let's continue. The foreign exchange market, forex or FX, we know today didn't appear overnight. It has evolved over centuries of global trade, economic shift, and technological innovation. From the ancient barter system to today's $7 trillion a day digital marketplace, the history of Forex tells the story of how money, power, and technology shape global commerce. In this content, we will expose the entire journey, how Forex began, the major turning points in its history, and how it continues to evolve in the modern world. Are you getting my point? Number one, let's begin. The ancient root of currency exchange. Before paper money or digital wallet existed, people traded through the barter system, exchange of goods and services directly. For example, a farmer might trade grain for meat, a craftsman might exchange tools for clothing. While this worked locally, it became complicated as trade expanded between nations. A standardized medium of exchange was needed, and thus money was born. Then the birth of currency. Around 600 BC, King Aleta of Lydia in the modern-day Turkey minted the first official coins made of gold and silver. These coins allow merchants to determine the value of goods easily and facilitated international trade. As empires expanded, currency exchange became necessary to trade across borders, making the earliest form of foreign exchange. Number two, the gold standard era. From 1870 to 1914, forward to the 19th century, when global trade and travel increased dramatically, nations needed a stable system to determine the value of their currency. The gold standard was born. In 1875, the gold standard was introduced. This system linked each country this system links each country's currency to a specific amount of gold. For example, 1 British pound equals to X gram of gold. $1 equals to Y gram of gold. This made it easy to exchange currencies because the value of each currency was tied to gold. Benefit and limitation. Because during those periods there were benefits and also there were limitations. Number one, provided global stability and trust in currencies. Number two, limited government's ability to print money and control their economies. This system worked well until World War I, when countries suspended the gold standard to print more money to finance war efforts. This marked the beginning of modern monetary instability. Number three, the Bretton Woods Agreement, which began in 1944 to 1971. After the devastation of Second World War, world leaders met in Bretton Woods, New Hampshire, USA, in July 1944 to rebuild the global economy. What happened at Bretton Woods? 44 countries agreed to create a new international monetary system. Currencies were pegged to the US dollar, and the US dollar was pegged to gold at $35 per ounce. Then the US dollar became the world reserve currency as America held most of the world's gold reserve. Creation of global finance institution. Bretton Woods also led to the creation of the International Monetary Fund and the World Bank. These institutions still play a major role in global finance today. Number four, the collapse of Bretton Woods and the birth of modern Forex in 1971. By the late 1960s, the US was printing more dollar than it could back by gold due to military spending, especially during the Vietnam War. Confidence in dollar began to fall. Then, the Nikon shock. In 1971, the US President Richard Nixon made a historic announcement. He ended the dollar convertibility to gold. This decision collapsed the Bretton Woods system and allowed currencies to float freely against one another. From that moment, exchange rates were determined by supply and demand, not by government fixed price. This event marked the true birth of modern Forex. Then, number five, the rise of electronic trading from 1980s to 1990s. Once currencies were free floating, the Forex market grew rapidly. But it wasn't until the technological revolution of the late 20th century that forex trading became truly global and accessible. In 1980s, computer computers entered the scene. Banks began using computers to put prices electronically instead of via phone calls. Trading became faster, more efficient, and more transparent. I get my point now. In 1990s, the internet revolution. With the rise of the internet, forex trading moved online. Retail investors, not just banks or institutions, could now trade currencies through online forex brokers. Then this demo this democrat this democratized the market, opening doors for millions of independent traders worldwide. Number 6, forex in the 21st century, digital and global area. Today, the forex market has evolved into a fully digital, highly liquid 24 hours global marketplace. The key development is this: they were invention of MetaTrader platform, which is the MT4 and MT5, introduced in early 2000. They revolutionized the retail trading. Algorithmic trading, automated trading now execute trade in milliseconds using AI and algorithm. Then we have mobile trading apps, platform like XNET, IC Market, Deriv allow anyone to trade from their smartphone. Then we have cryptocurrencies. The emergence of digital assets like Bitcoin has introduced a new dimension of currency trading. Today, the forex market processes over $7 trillion every single day, making it the largest and most active financial market in the world. Are you getting my point now? The future of forex trading. Forex continue to evolve with AI technology, blockchain innovation, and global economic changes. And here is what the future may hold. Number 1, artificial intelligence and machine learning. Smart system that analyzes data faster than human. Blockchain integration, more transparency and secure transaction. Digital currencies, which is CBDC, meaning central bank developing their own digital currency. Social and copy trading, platform allowing traders to copy expert traders in real time. Then number 5, regulation and security, tighter oversight to protect traders from fraud and manipulation. Then let's continue. The forex market of tomorrow will be smarter, faster, and more connected than ever before. The key summary is this. As you can see, the key summary in forex history, the period, the event and impact. The ancient times, the barter and first coin, which is the birth of first trade and currency exchange. Then in 1980 and 1914, we have the gold standard, we have the stable currency, the stable global currency value. In 1944, we experienced Bretton Woods agreement. USD became global reserve currency. Then in 1971, we experienced the collapse of Bretton Woods and floating exchange rate introduced. Then we have the 1980s, we have computerization, then faster and more efficient trading was introduced. In 1990, we have an internet revolution, then online retails and trading begin. Then in 2000 to present era, we have digital era, AI, mobile app, and 247 internet access were introduced. So in conclusion, the history and evolution of forex is a fascinating journey from ancient trade routes to the AI-driven global market. What began as a system of barter and gold exchange has now connected into a multi-trillion-dollar digital marketplace that connects the entire world. So today, anybody or anyone with smartphone and internet connection can participate in the same market once dominated by banks and government. The forex market is not just about trading currency, it is about the story of human progress, innovation, and pursuit of global economic balance. Understand? So let's continue. Now we'll be talking about forex market participants, which I will explain as retail traders, bankers, hedge fund, government, and brokers. Understand? The foreign exchange market, which is forex, is the largest and the most liquid market in the world. with daily transactions exceeding $7 trillion. But have you ever wondered who exactly is trading the money? Are you getting my point now? The forex market is not just made up of individual traders, but like it is not made up of individual traders like you and me. It also involves a wide range of participants, from central banks, the financial institution, to hedge fund brokers and rate traders, which are the retail traders. Every participant play a unique role in or how forex market operates and affects global currency price movement. So in this video, you will explore the main participants in the forex market, their function, and how they influence currencies. In this overview, who are the major forex market participants. The forex market functions as a decentralized network. There is no single exchange or location where the trading happens. I go to my point right now. Instead, participants from around the world trade electronically through banks, brokers, and trading platforms. And here are the main participants in the forex market, which are central banks and government, commercial and investment banks, hedge funds and financial institutions, retail traders, and forex brokers. Now let's explore each group in details. Number one, the central bank and government. At the top of the forex hierarchy are the central banks and the government. They play the most influential role in the entire forex ecosystem. Who are they? Examples include the US Reserve, the US Federal Reserve, which is called the Fed, the European Central Bank, which is called the ECB, the Bank of England, which is called BOE, the Bank of Japan, which is called BOJ, and the Central Bank of Nigeria, which is called the CBN. Their role are these. Central banks are responsible for the monetary policies, which means controlling money supply and interest rates, maintaining country's currency stability, and also intervening in forex market to control inflation or stabilize exchange rate. For example, when a country's currency becomes too strong, the central bank may sell its currency to weaken it may so that it makes exports cheaper. Conversely, if the currency is weakened too much, the bank may buy it to support its value. This intervention can cause massive price movement in the forex market. Example, when the Swiss National Bank removed its cap on Swiss franc in 2015, the currency skyrocketed, shocking traders and institutions worldwide. This shows how influence central banks have on the market. Number two, commercial and investment bank. Next one are commercial and investment bank, which are the main players in the interbank forex market. They are responsible for the majority of daily forex trading transactions. Who are they? These people are JP Morgan Chase, they are Citibank, they are the Deutsche Bank, they are HSBC, they are Barclays, and they are UBS. Their role are facilitating client transactions. They help multinational companies, importers and exporters convert currency for international trade. Then speculation and profits. Banks also make trade forex to make profits from exchange rate movement. Liquidity providers, they act as market makers, providing buy and sell prices quotes that helps keep the market liquid. In short, commercial banks form the backbone of the forex market, handling billions in trade daily. Number three, hedge funds and financial institutions. Hedge funds, asset managers, and investment firms are also participants in forex market. They manage large portfolio and often trade currency as part of their investment strategies. Who are they? Examples include Bridgewater Association, BlackRock, Soros Fund Management. What are their roles? Speculation. Hedge funds often make aggressive trade to profit from short-term market movement or economic news. Then hedging. Large investment firms use forex to protect their portfolio from currency risk. For instance, if a fund invests in European stock but fear the euro will fall, they can hedge by selling the euro USD pair. Micro strategies. Some funds trade based on microeconomic events such as interest rate decision or political instability or global financial crisis. For example, in 1992, billionaire George Soros made over $1 billion in a single day by betting against the British pounds, an event known as Black Wednesday. This is one of the most famous hedge fund forex trades in history. You understand? Then retail traders, which is number 4. Who are they? Retail traders are individual investors who trade currency for personal profits for personal profit through online forex brokers. Who are they? Retail brokers. Retail traders include full-time traders, part-time traders, beginner learning to trade, professional managing personal portfolios. What are their role in the forex trading? Retail traders make up a small percentage of the total market volume, around 5 to 6%. They are fast growing segment thanks to technology and online accessibility. They trade using trading platforms like MetaTrader 4 and MetaTrader 5. Leverage, which is being provided by the brokers. Strategies based on technical and fundamental analysis. Then you may ask, why the retail trader forex has exploded? Number 1 is because of 247 24 hours access. Trade anytime and anywhere around the world. Low entry requirements. Start with as little as $10. Educational resources, countless free courses and demo accounts. Number 4, mobile trading apps. They can trade directly from smartphone again, no longer going to the bank to trade. Then retail traders have transformed forex into a global phenomenon where anyone can now participate in the forex market. So let's continue. Number 5, forex brokers. Forex brokers are the bridges that connect retail traders to the forex market. Without them, individuals won't have access to global currency trading. Types of brokers. We have dealing desks or market makers. These brokers create their own internal market. They take the opposite side of the trade, offering fixed spread. No dealing desks or ECN or STP. These brokers connect you directly to liquidity providers, banks or institutions. They offer variable spread and faster execution speed. Their role is to provide trading platforms like MT4, MT5 or Street Trader, offer leverage and margin accounts, facilitate deposit and withdrawal, and also supply market analysis, education and support. Example of popular forex brokers which I am also make my investigation on are XNES. I'm using that one. IC Market, XM, Deriv. I'm using Deriv, FXTM and Pepperstone. These are 6 brokers that are well regulated and are highly licensed and are legit. Are you getting my point now? Brokers have also revolutionized forex by making it accessible, fast and convenient for millions of retail traders globally. Are you getting my point now? In summary, these are the structure of the forex market. You have the participants, you have their role in the market, and we have their influence level. Central bank sets monetary policies and stabilize the currency. Their influence level is very high. Commercial and investment bank facilitate transaction and provide liquidity high. Hedge fund and financial institution, they speculate, hedge and manage large portfolio. They have high influence. Retail traders trade for personal profits. They have modest influence in the market. Then brokers provide market access to trading platform and also support the traders because their influence are supportive. Are you getting my point now? Then the forex market operates like a pyramid. Are you getting my point? So it operates like a pyramid from the central bank to the commercial and investment bank to the hedge fund and financial institution to the retail traders, then to the brokerage firm. So it is a hierarchy by hierarchy. So the central banks and the major financial institutions sit at the top. The brokers and retail traders operate at the base. Yet everyone is connected through technology and liquidity flows. Then my final thought on this is this: the forex market is a dynamic ecosystem powered by a diverse mix of participants. Each player plays a vital role in keeping the market alive, liquid and ever-changing. From the government shaping monetary policy to individual trading from their phone, every participant contributes to the constant movement of the global currency. Whether you are a beginner or an experienced trader, understanding who moves the market and why gives you the huge advantage helping you to make smarter, more informed trading decisions. Let's continue. Forex market structure: spot, forward, future, option, or swap. The foreign exchange market, also known as Forex or FX, is the largest and most liquid market in the world. As I always tell you, it operates 24/7 hours a day. It operates 24 hours in a day, 5 days in a week, allowing participants across the globe to buy, sell, exchange, and speculate on currency. To truly understand how market works, it's important to know its structure, the various ways currency can be traded. The forex market is not a single centralized exchange, but rather a network of interconnected participants using different types of contracts. The main segments that make up the structure of the forex market are the spot market, forward market, futures market, option market, and swap market. Each plays a unique role in how currencies are traded and managed. Number one, the spot market. The spot market is the simplest and most common form of currency trading. In this market, currencies are exchanged immediately at the current price known as the spot rate. The trade is settled on the spot, typically within 2 business days. For example, if a trader buys Euro USD at 1.0850, it means they are buying the Euro and selling the US dollar at that price, with delivery taking place shortly afterward. Who uses the spot market? Retail traders like me and you. Banks, corporations, they need to exchange currency for business operation. Advantages of spot market: high liquidity and quick execution, transparent pricing based on market supply and demand, which is ideal for short-term traders and scalpers. Number two, the forward market. The forward market involves contracts to buy or sell a currency at a future date, but at a price agreed upon today. This type of trade is not standardized and usually done over the counter (OTC) between two parties. Forward are mainly used to hedge against currency inflation. For example, if a company knows that it will receive payment in euro in 3 months, it might lock in today's exchange rate so as to protect itself from future volatility. So who uses this forward market? We have corporations with international operation, we have importers and exporters managing foreign exchange risk, and also we have banks and large investors hedging exposure. Advantages of forex forward is customized contract tailored to specific needs, protection against future price changes, and useful for long-term currency exposure management. Number three, the future market. The future market is similar to the forward market, but very key difference: futures contracts are standardized agreements traded on regulated exchange such as Chicago Mercantile Exchange. A futures contract specifies the quantity, price, and settlement dates of a currency trade. Unlike forward, futures are regulated, transparent, and guaranteed by a clearinghouse, reducing a counterparty risk. Who uses the futures market? Institutional investors, hedge funds, professional traders. Advantages of futures market: standardized and regulated contracts, lower counterparty risk, high liquidity and transparent pricing, suitable for speculative and hedging process. Example: a futures trader might buy a contract purchase of 100,000 euro at a specific price in December, expecting the euro to rise in value. Then the option market. The option market gives traders the right but not the obligation to buy or sell a currency at a specific price before a certain date. There are 2 main types of options: call option, which is the right to buy a currency, and put option, which is the right to sell a currency. Options are commonly used by corporations and investors who want flexibility in their trading and hedging strategies. Who uses the option market? Corporations managing exposure, hedge funds and institutional traders, speculators seeking leverage opportunities. Advantages of option market: flexibility, you are not obligated to execute the trade. Number 2, you can limit losses while maintaining profit potential. Number 3, useful for complex hedging and speculative strategies. Example: A trader can call option on GBP USD at 1.2700 expiring in a month. If the rate raises to 1.2900, the traders profit. If not, they lose only the premium paid. If not, they lose only the premium paid. Number 5, the swap market. The swap market is primarily used by banks, financial institutions, and government. A currency swap involves exchanging one currency for another and agreeing a reverse the trade at a future date at an agreed rate. Swap are commonly used to manage liquidity, reduce borrowing costs, or hedge long-term exposure. Who uses swap market? The central bank and government, corporation and financial institution, banks managing foreign currency reserve. Advantages of swap markets: helping institutions manage long-term cash flows, reduce borrowing costs, useful for balancing currency reserve. Example: a US bank might enter a swap with a European bank to exchange dollar for euro for 6 months, then reverse the trade later. Summary: here are the table of all these things that I have listed: the market type, settlement time, contract type, used by who, and main purpose. So the spot trading, you have the forward trading, you have the future trading, you have the option trading, and we have the swap trading. All of them have their contract type, and all of them are being customized in different ways. So, but mainly these are the people, these are the hierarchies of big banks, hedge fund, corporation. In all these things I'm doing, these are how the forex market, different ways it is being traded. Understand? So in conclusion, the forex market structure is a vast and integrated business, proving various instruments to suit different participants, goes from quick speculative trade to long-term risk management. Understanding each opponent, spot, forward, futures, option, and swaps functions is essential for any trader or investor looking to navigate the global currency market effectively. Whether you are a beginner or a retail trader or second financial professional, grasping the structure of the forex market will give you the foundation to trade smarter and manage your risk better. Are you getting my point now? Then let's go to advantages, disadvantages, and risk of forex trading. The foreign exchange market, which is forex, is the largest and most liquid financial market in the world. Every day, more than $7 trillion worth of currencies are traded across different time zones. It attracts millions of traders, from individuals and banks to corporations and governments, all of them trying to make profit from currency price movement. While forex trading offers many opportunities for profit, it also carries a significant risk. To succeed in this market, every trader must understand both advantages, disadvantages, as well as potential risks involved in this business. Understand? Let's explore them in details. Number one advantage of forex trading. Forex trading has many benefits that makes it one of the most popular financial market global business. Here are some major advantages. Number one is high liquidity. The forex market is the most liquid market in the world, meaning there is always a buyer and a seller for any currency pair. This liquidity ensures that trades can be entered and exited quickly with minimal price differences between the buy and sell price, known as the spread. Benefits: faster execution and lower transaction cost. Number two, 24 hours market. Unlike stock markets that open and close at specific time, the forex market operates 24 hours a day, 5 days in a week. Trading starts in the Asia Pacific region, moves to Europe, and finally to North America before repeating the cycle. Benefits: traders can trade at any time, making forex flexible for people in different time zones with busy schedules. Number three, leverage opportunities. The forex market or forex brokers offers leverage, which allows traders to control larger positions with a small amount of capital. For example, with 1:100 leverage, a trader can control $100,000 worth of currencies with just $1,000 in their account. Benefit: increase profit potential on a small capital. But caution, while leverage magnify profit, it can also amplify your losses. So you need to be very careful when you make use of leverage. Number 4, low transaction cost. Compared to financial market, forex trading costs are relatively low. You understand? Most broker charges only a spread, which is the difference between the buy and sell price, or a small commission. The benefits are traders can keep more of their profits. Then number E, accessibility for everyone. Anyone with an internet connection can start trading forex. There are no strict barrier to entry, and most brokers offer demo accounts where beginners can practice before trading with real money. Benefits: easy entry for beginners and retail traders. Then number F, diverse trading opportunity. Forex offer multiple currency pairs, major, minor and exotic pairs, giving traders a wide range of opportunities. No matter the market condition, rising or falling, traders can profit from buying or selling their currencies. The benefits are profit potential in both upward and downward market. Number G, transparency and global reach. Because forex trading is the global market, it is less likely to be influenced by individual player or organization. Prices are determined by real-time supply and demand, making the market transparent and fair. The benefits are equal opportunities for all traders. Disadvantages of trading forex: while forex has many advantages, it also carries with downside that traders must be aware of. Number 1, high volatility. Currency pair can change rapidly due to global news, political events or economic data releases. This volatility can create big announcements but also huge losses if not managed properly. The drawback are here: this sudden price swing can wipe out a trader's account. Number 2, leverage can be dangerous. Leverage is a double-edged sword. While it allows for bigger profit, it also increases the risk of losing money or more than your initial investment if the market moves against you. The drawback here is this: it amplifies your losses for inexperienced traders. Number C, lack of centralized exchange. Forex is an over-the-counter market, meaning that there is no single exchange or regulatory body overseeing all transactions. This can lead to differences in pricing and less transparency with some brokers. The drawback is this: risk of dealing with unregulated brokers or unfair practices. Number D, complex for beginners. Understanding how global events, interest rates and economic influences currency can be challenging. Forex trading requires time, study and discipline. Sometimes many traders underestimate. The drawback is this: steep learning curve for new traders. Number E, emotional stress. The constant price movement and risk of losing money can cause emotional stress. Many traders struggle with fear, greed and overtrading, which often lead to poor decision making. The drawback here is emotional trading can destroy profit and confidence. Then 3, risk involved in forex trading. Every trader must understand the risk associated with forex to protect their capital and make informed decisions. Number 1 risk is market risk, which is A. Market risk refers to potential loss caused by unfavorable price movement in the currency pair that you trade. Even if you are experienced trader, you cannot predict every market move. But I will give you a tip: always use stop loss order to limit your losses. Number B, leverage risk. As mentioned earlier, leverage magnifies both gain and losses. If the market moves against your position, your losses can exceed your initial deposits. But here are the tips: use leverage wisely and trade with a risk management strategy. Number C, interest rate risk. Currency values are heavily influenced by interest rate changes from central banks. From the central banks. If a currency interest rate rises, its currency tends to strengthen, and vice versa. Unexpected rate changes can cause huge market economic movement. So here is the tip you need to follow: Stay updated with economic calendar and central bank announcement. Number D, liquidity risk. While the forex market is highly liquid overall, not all currency pair have the same liquidity. For example, exotic pair can experience wider spread and price gap, making them riskier to trade. The tip is this: stick with major currency pair like Euro USD, GBP USD and USD JPY. Number E, broker risk. Choosing the wrong broker can lead to serious problem. Unregulated or fraudulent brokers can may manipulate prices, delay withdrawal or even disappear with your money. The tip is here. The tip I want to give you here is this: always choose a regulated broker licensed by authority as the FCA of UK, ASIC of Australia and or NFA of USA. Number F, psychological risk. Trading requires discipline and mental strength. Emotional reaction like fear, greed, and revenge trading can lead to poor decisions and major losses. Here is your tip: develop a trading plan and stick to it no matter the emotion. Number 4, how to manage your forex trading risk. To reduce exposure and trading safety, always use stop loss and take profit level. Never risk more than 1 to 2% of your trading account on a single trade. Stay informed about global economic news. Practice first with demo account. Keep a trading journal to track your progress. Control emotion and avoid overtrading. Then in conclusion, forex trading offers amazing opportunities for profit, flexibility and personal growth. However, it also involves real risk that can lead to financial losses if not managed carefully. The key to success lies in education, discipline and risk management. By understanding the advantages, disadvantages and risk, traders can make better decisions and increase their chances of long term in the global market of currency market. In forex, knowledge is power and risk management is survival. It is very important. In forex, knowledge is power and risk management is survival. So guys, if you have watched this video up to this moment, if you have watched this my first episode of forex trading journey up to this moment, congratulations to you on your first episode. So I will be seeing you on my next video, which is my second episode. But make sure you need to go back to this video once more and understand everything that I have taught you today. I promise you, you will not regret it. So if you have watched this video up to this moment, thank you for sticking with me. Thank you for sticking with me. Make sure you like this video. Make sure to subscribe to my channel, and also make sure you comment down below. Ask me any question concerning this forex course that I have already broken down for you, which is the first episode. And I will be seeing you on my next video, which is my second episode. Thank you for sticking with me. Take care. Stay safe. I love you. Bye for now.